Right now, either smart money is building the largest Bitcoin position of this entire cycle, or this market is structurally broken and the recovery you are waiting for is not coming. Those are not equally weighted possibilities. The data has a clear lean, and I'm going to show you exactly what the shakeout mechanism looks like from the inside, how it is engineered, who benefits from it, what the historical fingerprint of a final shakeout looks like versus a genuine breakdown, and the single observable signal that tells you which one this actually is before the move happens rather than after it. First 30 seconds, you are still here. Good. Because what I am about to show you is the analysis that separates the people who survive this market from the people who exit at the exact bottom and spend the next 18 months watching from the sidelines. Let's build the full picture right now, together. Bitcoin plunged from its all-time high of $126,000 in October 2025 to $60,000 on February 6, 2026, shedding $2 trillion in total crypto market value. The crash was driven by a convergence of leverage unwinding, $12 billion in ETF outflows, tech stock contagion, and the historical 4-year cycle psychology. 4 forces, arriving simultaneously, producing a collapse that felt like existential crisis but was structurally a mechanical and behavioral confluence, not a fundamental rejection of Bitcoin's value proposition. And the difference between those two things is the entire investment thesis. Bitwise CIO Matt Hugin identified the cycle psychology layer precisely. Long-term holders looked at the pattern from 2014, 2018, and 2022, decided to sell before 2026 could repeat it, and enough people acting on that thesis made it self-fulfilling. It was not a discovery of a fundamental flaw. It was not institutional abandonment. It was a behavioral feedback loop, and behavioral feedback loops are self-limiting by definition. They exhaust the sellers acting on the thesis. Once those sellers have acted, the selling pressure from that specific source is gone. Now let me show you the structure underneath this price action, because this is where the analysis gets genuinely important. The argument that the drop to roughly $60,000 was a textbook Wyckoff accumulation spring, the final shakeout before a major markup phase, is gaining traction among serious analysts. The Wyckoff method tracks how smart money accumulates assets, first by absorbing panic selling, then grinding sideways, then triggering a fake breakdown before a sustained uptrend. The spring is the most psychologically devastating phase of the entire sequence. It is specifically designed to look like a breakdown. It is supposed to feel like the end. Its function is to transfer Bitcoin from weak hands to strong hands right before the move begins, and the on-chain data is showing exactly that transfer happening in real time. Whale wallets are accumulating, exchange reserves are trending lower, more Bitcoin is moving into cold storage, a pattern linked to longer-term holding, rather than imminent distribution. Exchange reserves declining means Bitcoin is leaving venues where it can be easily sold. Cold storage inflows mean Bitcoin is moving into custody structures built for long-term holding. All 3 signals appearing simultaneously at the same price level is a convergence confirmation. Multiple independent data sources pointing to the same structural conclusion. And the miner behavior reinforces it from a completely separate analytical angle. When hash ribbons signal miner recovery after a stress period, it historically marks a market bottom. Miner capitulation followed by hash ribbon recovery is one of the most reliable bottom signals in Bitcoin's history. We are in that post-capitulation recovery phase right now. The weakest miners have shut off. The strongest remain. The forced selling from the miner cohort is exhausted. And historically, that exhaustion point has preceded some of the most significant recoveries in Bitcoin's cycle history. Now the sentiment data, and this is where I want you to pay very close attention. The crypto fear and greed index has been sitting at extreme fear since early February, the lowest sustained reading since the FTX collapse. Trading volume dropped 61% week over week during the worst of it. $8.7 billion in Bitcoin losses were realized in a single week, second only to the Three Arrows Capital blowup. Volume collapsing 61% means sellers are exhausted, not recovered, exhausted. The people who were going to sell have sold. $8.7 billion in realized losses in a single week is not the middle of a bear market. It is the maximum pain point and the moment of greatest psychological distress, which historically marks the end of the distribution phase and the beginning of accumulation. Here is the line I need you to hear. If you are waiting for the headlines to turn bullish before acting, you will be late. You always are. By the time the narrative flips, the move has already started. The people making money in this market are not the ones who waited for confirmation. They are the ones who understood the structure before the consensus caught up to it. Now the ETF data. Because this is the most misread signal in the entire current market, and getting it wrong produces completely incorrect conclusions. US spot Bitcoin ETFs logged 5 consecutive weeks of net outflows, the longest streak since February to March 2025. Year-to-date outflows reached approximately $4.5 billion by February 20th. That is the headline everyone is citing as proof of institutional abandonment. But here is what the same dataset shows when you look beneath the headline. There are two completely different institutional actors doing two completely different things simultaneously. Hedge funds running basis trade strategies are exiting because the spread between spot ETF prices and CME futures compressed to approximately 4% annualized, barely above short-dated Treasury yields, making the trade economically unviable. That is a mechanical strategy reaching its conclusion. It is not conviction exiting. It is not belief in Bitcoin's long-term value reversing. It is a quantitative arbitrage position closing because the mathematical conditions that made it profitable no longer exist. On the other side of that same flow data, long-duration conviction allocators, registered investment advisors, family offices, long-only institutional funds, investment advisors grew their aggregate Bitcoin ETF holdings every quarter over 5 consecutive quarters, resulting in a 145% year-over-year increase. The composition of Bitcoin ownership is actively shifting from short-duration tactical traders to long-duration conviction holders. And that shift is precisely what sets up the move, because long-duration conviction holders do not sell on the next 10% rally. They hold. Thin supply from holders who will not sell combined with any meaningful increase in demand produces explosive price appreciation. Now the level, the specific number that defines everything from here, not 60,000, not 55,000, 58,000, that is the line. If Bitcoin closes below $58,000 on high volume, the market signals structural failure and opens downside toward $48,000. That specific level, identified by multiple independent analytical frameworks converging at the same point, is the binary that defines this entire market. Above it, the Wyckoff spring thesis holds and accumulation is in progress. Below it, on high volume, the bear continuation scenario demands reassessment, and the 48,000 zone becomes the next structural test. Holding above 60,000 confirms a reaccumulation phase. If Bitcoin holds this zone for several months, Wyckoff theory suggests a transfer of assets from weak hands to institutional buyers is completing. The zone is defined, the signal is defined, the mechanism is defined. What remains is observation, watching whether the zone holds or breaks, and adjusting probability weighting accordingly. Clean binary, maximum clarity, no ambiguity. Now the macro liquidity framework, because without it, the timing question has no answer. Bitcoin, as the highest beta risk asset in existence, responds to shifts in global risk appetite with greater force and speed than any other asset class. The ISM manufacturing PMI crossing 50 signals the transition from contraction to expansion, and current projections indicate that crossing occurring in Q2 2026 as policy changes take effect. Every prior instance of PMI crossing from below 50 to above 50 during a Bitcoin accumulation phase has been followed by significant price appreciation within 2 to 4 months of the crossing. If the Q2 projection materializes, it aligns precisely with the Wyckoff spring structure, the on-chain accumulation signals, and the miner hash ribbon recovery. 3 independent analytical layers pointing to the same timing window. The U.S. government faces a $9 trillion liquidity gap from debt maturing in 2026 combined with the standard annual deficit. Raoul Pal identified this dynamic first. Bitcoin is a liquidity asset. The 4-year cycle is a purely liquidity-based cycle. $9 trillion of debt maturity pressure creates a structural liquidity expansion imperative with a defined timeline, and Bitcoin, as the highest beta liquidity asset in existence, responds to that expansion with disproportionate force. The fiscal calendar is not a prediction. It is a schedule, and it points toward the second half of 2026 as the period when the liquidity dynamic shifts decisively. A constructive base case clusters around end 2026 price levels between $120,000 and $170,000, consistent with the bulk of institutional forecasts if ETF inflows remain positive, rate cuts proceed gradually, and no major regulatory shock hits. Those are not fringe targets from permabulls. They are the outputs of institutional capital flow models built by the same firms managing the portfolios that drove the last bull run, projected from a current price that sits 53% below the all-time high. The setup is as structurally aligned as this market produces, and it is being built quietly, beneath maximum fear sentiment, while the headlines tell a completely different story. Let me give you the 3 observable signals that confirm the shakeout is complete and the move has begun. Before the mainstream narrative catches up, before the headlines flip, before the crowd comes back in. First, the ETF outflow streak breaking and flipping to sustained inflows. That signals the basis trade unwind is complete and conviction capital has replaced tactical capital as the dominant institutional force. Watch the weekly flow data. The flip is the trigger. Second, the $58,000 level holding on any retest with declining volume. Declining volume on a test of support is the technical definition of selling exhaustion. It is the prerequisite for the next directional move. If the level holds and volume shrinks on the test, the shakeout is completing. Third, the ISM manufacturing PMI crossing 50. That is the macro confirmation that the global liquidity environment is transitioning from contraction to expansion. It is not a Bitcoin-specific signal. It is a global capital allocation signal that historically precedes the most powerful phase of Bitcoin's cycle move. All three appearing in sequence means you are watching the final shakeout resolve in real time. The trap that was set for retail is closing, but Bitcoin is not the prey. It is the bait, and the smart money sitting behind it has been accumulating every single day that you have been reading the headlines and considering selling. Here's the reality that this entire analysis comes down to. The trap is set. The shakeout is either completing or extending. The data leans heavily toward completing. The structure leans heavily toward completing. The sentiment, the miner behavior, the on-chain flows, the institutional positioning, the macro liquidity calendar, every layer of this analysis is pointing in the same direction with the same conclusion. Not certainty, probability. And probability applied with discipline and patience over time is the only edge that actually compounds in this market. The move is coming. The only question is whether you will still own Bitcoin when it does. See you in the next one.